Gold, a precious metal desired for its beauty and rarity. Throughout history, it has held a unique place in human societies, becoming a symbol of wealth and power. It is this intrinsic value that led to gold's adoption as a monetary standard, shaping the global economy for centuries. This essay delves into the fascinating history of the gold standard, exploring its impact, its eventual demise, and the ongoing debate surrounding its legacy. The gold standard emerged as a dominant monetary system in the 19th century, gaining traction after the Industrial Revolution. As international trade flourished, a standardized system became essential to facilitate smooth transactions across borders. Gold, with its inherent value and global recognition, provided a solution. By pegging their currencies to a specific amount of gold, countries created a fixed exchange rate system. This facilitated international trade and investment by providing stability and predictability in currency values. The adoption of the gold standard marked a significant shift in global finance. It ushered in an era of unprecedented economic integration, fostering trade and investment on a global scale. The gold standard's influence extended beyond economics, shaping international relations and influencing the course of history. The mechanics of the gold standard were surprisingly simple. Each country participating in the system defined its currency's value in terms of a fixed weight of gold. For example, the United States dollar was pegged to gold at a rate of $20.67 per ounce. This meant that anyone holding US dollars could, in theory, exchange them for gold at that fixed rate. This convertibility between currency and gold was a cornerstone of the system. It instilled confidence in the currency's value, as it was directly linked to a tangible and universally valued asset. If a country experienced a trade surplus, accumulating gold reserves, it could issue more currency, expanding its money supply. Conversely, a trade deficit led to an outflow of gold, requiring a contraction of the money supply. This self-regulating mechanism aimed to maintain price stability and prevent inflationary spirals. The gold standard imposed fiscal discipline on governments, limiting their ability to engage in excessive spending or manipulate currency values. This, in turn, fostered an environment of price stability and predictable exchange rates, which facilitated international trade and investment. Under the gold standard, international trade experienced unprecedented growth. The stability of exchange rates provided businesses with the confidence to engage in cross-border transactions without the fear of volatile currency fluctuations. This predictability reduced risks and transaction costs, making international trade more attractive and accessible. The gold standard fostered a period of globalization, with goods, capital, and people moving more freely across borders. This interconnectedness led to increased trade, investment, and economic growth on a global scale. The expansion of international trade under the gold standard had a profound impact on economies worldwide. Developing countries gained access to new markets for their raw materials and agricultural products, while industrialized nations benefited from cheaper imports and expanded export markets. This led to increased specialization and efficiency, as countries focused on producing goods and services where they had a comparative advantage. The gold standard's most significant contribution was arguably its role in promoting price stability. By linking currency to gold, the system limited the ability of governments to manipulate the money supply, a common cause of inflation. This inherent stability provided a predictable economic environment, conducive to long-term planning and investment. Businesses could confidently invest in new projects, knowing that their investments wouldn't be eroded by runaway inflation. This stability also benefited consumers, who could rely on relatively stable prices for goods and services. The gold standard's emphasis on fiscal discipline prevented governments from engaging in excessive spending or accumulating unsustainable levels of debt. This fiscal prudence contributed to balanced budgets and a more stable economic environment. The combination of price stability, fiscal discipline, and predictable exchange rates created a favorable environment for economic growth. While the gold standard wasn't without its critics, its contribution to global economic stability and growth during this period is undeniable. Despite its successes, the gold standard faced growing criticism and challenges in the early 20th century. One major criticism was its inflexibility in responding to economic shocks. Because the money supply was tied to gold reserves, governments had limited ability to use monetary policy to mitigate recessions or stimulate growth. Another challenge was the unequal distribution of gold reserves worldwide. Countries with large gold holdings wielded significant influence over the global financial system, while those with limited reserves faced constraints on their economic policies. The gold standard also struggled to accommodate the growing complexity of the global economy. As international trade and capital flows increased, the fixed exchange rate system became more difficult to maintain. These challenges, coupled with the outbreak of World War I, led to the suspension of the gold standard by most countries. The outbreak of World War I in 1914 marked a turning point for the gold standard. The conflict disrupted global trade, forcing countries to abandon the gold standard to finance their war efforts. Governments needed to print more money to fund their militaries and support their economies, which was impossible under the strict rules of the gold standard. The suspension of the gold standard during the war had significant economic consequences. Freed from the constraints of gold convertibility, governments resorted to printing money to cover their war expenses, leading to widespread inflation. The war's aftermath left many countries with depleted gold reserves and unstable economies, making a return to the gold standard challenging. While some countries attempted to restore the gold standard in the 1920s, these efforts proved short-lived. The global economy had fundamentally changed, and the gold standard, once a symbol of stability, seemed ill-equipped to handle the challenges of the post-war world. The Great Depression of the 1930s delivered another blow to the gold standard, exposing its limitations in addressing severe economic downturns. The fixed exchange rates became untenable as countries sought to protect their economies through competitive devaluations. The need for greater flexibility in managing exchange rates and monetary policy became increasingly apparent. In 1944, as World War II raged, representatives from 44 Allied nations gathered in Bretton Woods, New Hampshire, to reshape the global financial system. The Bretton Woods Agreement marked a significant departure from the gold standard. It established a new system with the US dollar as the world's reserve currency, pegged to gold at $35 per ounce, while other currencies were pegged to the dollar. This system aimed to combine the stability of a gold-backed system with the flexibility of adjustable exchange rates. However, the Bretton Woods system faced its own set of challenges in the post-war era, ultimately leading to its collapse in 1971, when President Nixon ended the dollar's convertibility to gold. The gold standard's legacy remains a subject of intense debate among economists and historians. Proponents argue that it promoted price stability, fiscal discipline, and economic growth. They point to the era of relative prosperity and globalization that coincided with its widespread adoption. Critics, however, argue that the gold standard was too rigid, limiting governments' ability to respond effectively to economic shocks. They point to its role in exacerbating the Great Depression and argue that it hindered economic growth by limiting the money supply. The debate over the gold standard often reflects differing views on the role of government in the economy. Advocates of limited government intervention tend to favour the gold standard's emphasis on fiscal discipline and price stability, while those who believe in a more active role for government in managing the economy often criticise its inflexibility. Despite its demise as a formal monetary system, gold continues to hold a lure as a safe haven asset in times of economic uncertainty. Investors often flock to gold during periods of high inflation, geopolitical instability, or financial market turmoil. Gold's inherent value and limited supply make it a hedge against inflation, as its purchasing power tends to hold up better than fiat currencies during inflationary periods. Central banks worldwide continue to hold significant gold reserves, recognizing its role as a store of value and a source of confidence in the global financial system. While gold may no longer be the foundation of the international monetary system, its enduring relevance in modern finance is a testament to its historical significance and its enduring appeal as a safe haven asset. The gold standard's journey from its rise as a dominant monetary system to its eventual demise offers valuable lessons for understanding the complexities of managing global finance. Its legacy is a mixed bag, marked by both successes and failures. While the gold standard promoted price stability and facilitated international trade, its rigidity and susceptibility to external shocks ultimately led to its downfall. The debate over its merits continues to shape discussions about monetary policy, the role of government in the economy, and the search for a stable and equitable global financial system. As we navigate the complexities of the 21st century economy, understanding the lessons of the gold standard can provide valuable insights into the challenges and opportunities of managing global finance in an increasingly interconnected world.